Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 4th, 2024. It's 11:32 a.m. Eastern Time, so we are just over 2 hours into the trading day and figured I'd just get a brief one out to you. I did a pretty long and pretty detailed video yesterday, so we'll keep this one brief and just keep in mind. First of all, we have a data pack week, but of course today's reports are out of the way. We had jolts today, and then market had a knee-jerk reaction down, then up. I got this out to you this morning. Figure we bounced today. Where of course yesterday was a down day. It was big. It was on NQ at least down over 3%. And you get quite oversold when that happens, and basically oversold at support as a recipe for a bounce. Doesn't change my longer term outlook, but let me show you some charts where if you're an active trader, and even if you're a swing trader, more typical swing trader, what I highlighted here, and I'm going to go down in a second and show you. We might get one more thrust up. So that was this morning. We gapped, this is gap support. You can see, that's a gap so big a blind man could see it. And it's not just there. That's the top of the gap right here at, whatever that level we hit this morning. And then you have this big old gap right here as well. So that's the bottom of the gap as well. So it's really double gap support. And, all right, so that was the one I got out to you this morning. And then, the important thing, and I make sure to put this in there, not any back tests, near back tests. So the range would offer an objective short entry or exit if you're going to game a bounce there. Why? Because all eyes are on it. That's about as obvious as a level as you get. And the way it works in trading, investing, if a level is so obvious and everybody's looking to, either sell their longs on it or short it, yeah, you can certainly hit it. That's possible. And however, you tend to get people like myself that tend to want to rather sell early. I don't want to miss the turn. So I already did it, but I'm already back in. Let me show you why. This is QQQ. Arrow breaks are all, like I said, potential bounce targets. And let me, show you what I posted on the follow-up. Anytime that you're interested in one of the front page posts, anything covered there, let's say I post an update on wheat, which I'll probably get to in this video if there's time, or something else. I will, if there's something else to add, or especially in weeks like this where you're going to have market volatility. This is going to be a grindy, bouncy week with all the economic reports. So far the grind has been to the downside, but today was up. But now we're about flat again. So here's what I added on there, and I haven't refreshed the page, but lots of eyes on the 555 bottom of the range resistance. So sellers likely to step in early. Wouldn't be surprised to see another thrust up after the pullback not off 555, just shy of 555, to run it back into the range and blow out the shorts with a washout pop up to the 557.35 resistance before the next major leg down. 5-minute chart of SPY below as the nearby levels seem better defined than QQQ, so in other words, I'm putting a significant weighting on the charts of SPY and ES, even though I'm trading NQ. So that's just a little insight to how I tick. Usually, obviously, you want to focus on the chart of what you're trading first and foremost. But again, SPY and the ES, the S&P 500, and SPY being the tracking ETF and ES being the futures, is still one of the most liquid, most traded indexes in the world, if not I believe it is especially for investors with 401ks. You don't have many and NASDAQ 100 funds in your 401ks. You have usually S&P 500 fund, mid cap and small cap funds, that kind of stuff. Anyway, lots of eyes on the five. So this is what I posted earlier as we're coming up to it. Lots of eyes on the 555, which resistance, bottom of the range, meaning this is bottom of the trading range, the one I've been harping on since last week. And so I wouldn't be surprised to see another thrust up after. So anyway, so sellers likely to step in early. Wouldn't be surprised to see another thrust up after that, meaning see this little arrow, pull back. Dotted arrows are, solid arrows are always my primary, most confidence, trade. Dotted arrows are a maybe and something, I think good chance, but we'll see. Well, first of all, this isn't going to happen right here, this scenario, unless we reverse first, right? If that's it and boom, and that's all we get, and then this thing's just going to go down, and then the next leg down starts, then that scenario doesn't wipe out. So look for the turn here. I think we'll get it today. I can't explain it. It's just how I trade. It's intuition, experience. I think we'll probably see that. I think a lot of what I call JCL, Johnny Come Lately shorts, piled into the short ETFs yesterday, SQQQ, bought a bunch of puts and all that stuff. And the market just, they can't make it easy for them. You should have been short coming into yesterday, covering or those shorts maybe on today's drop down because we hit, support, right after the open today. And, you got to be one step ahead of the market and how most people are thinking. All right, so to reiterate, that's the scenario. I wouldn't be surprised to see another thrust back up into the range right here. That would pop a lot of stops. A lot of short sellers probably shorted there, as they should have, on the near test. And that was, we were at 553.92, and I got that out to you. And let's just see where we are now. 553. Let's see. The high of the day was 554.43. We're talking basis points, a mere fraction, a tiny fraction of 1%. That's basically the highs, and that's exactly what happened. There's that chart I got out to you in that update, and they reversed it pretty much exactly where I figured, just shy of the level, and as did I. But started the video, I reversed back because that's that area I had. Again, you can go in and just follow up on the post, subscribe to the comment updates. By the way, I believe we've fixed something. Some of you weren't getting emails directly from the site. I'm digressing here for a second. When you get a new post update, every time a new post is published on the homepage, that comes from MailChimp, who's the largest email marketing provider, I believe, out there. I have to pay for that because I'm sending bulk emails. Otherwise, they'd be flagged as spam from all the internet service providers. So that's a service, and those go out and they make sure they're not hung up in your spam folder. They shouldn't be. When you click here, if you subscribe to a thread right here, new follow-up comments, new replies to my comments, that'll go to your email address that you have registered with the site, and that goes directly from right side of the chart.com. So make sure that's not getting snagged in your spam folder. There was an issue where some internet service providers were flagging those as spam because they do go out in bulk. If multiple people subscribe to this, let's say this one thread, the comment thread, it's going to send as many emails out at one time, and therefore there's that potential to be flagged as spam. So I just wanted to say there was some changes we made recently to the site, and I believe that will have fixed that issue. Okay, so let's continue on. A quick reply to that, and then I followed up with the 15-minute chart of ES, which is another reason to reverse shy would just kiss the bottom. So although I first gave you the chart of SPY, right after that, right at the time we were reversing there, see this is a 5-minute chart. That's that same trading range. And this, guys, and you've heard me say this, if you followed me for a while, you've heard me say this hundreds of times over the years. This is why I follow in both the ETFs and the futures, even if I'm only trading one or the other. In other words, when I'm trading the large caps, which I'm often doing, the indexes via usually NQ, sometimes I will favor the S&P 500 for certain reasons. Let's say the financials start breaking down, and I think you're going to see outperformance in the SPY. Sometimes you get that, or ES. I'll trade that. However, this is a reason why even if trading only SPY, only QQQ, you also want to look at the futures, because at the same moment that SPY reversed, visibly shy, comfortably shy of the level as expected, ES was hitting the comparable resistance level. So remember, the futures are just that. These levels are not always going to align, and they usually won't align perfectly because futures are pricing in what traders think that the indexes are going to be in the future. This is the, September 20th. This contract expires September 20th. So there's always a premium built into the futures. And that's that whole fair value thing they try to calculate for you on CNBC in the morning. based on where the futures are and what the index itself should actually be opening. So, anywho, guys, there it is. So that's kind of that we got so far. We got the bounce, we got the reversal. So you can 1, 2, you could book it here, you can or trail it down. But this is where I think it's going. So I've reversed. I'll give it a little bit of room. I can see a little uptrend line here, right about right here that might form. That's not it. Give me my line tool here. There you go. And so something like this and that. And so, take a shot here. And if they go much lower, I'll give it down here. I don't want to visit the lows of the day. Usually when you get down to the lows, you're either going to go down through there or you're going to reverse a little shy. So I'll put my stops out of range here, down here. Try to gain one more bounce up. This would be a nice scenario for shorts. Why? You might say, well, Randy, that sounds crazy. Shorts would prefer to see this. They would, but I don't like to be on the same team as them. I like to be a lone wolf when I'm shorting. I want most shorts blown out. If this was too easy. That's kind of why I had these arrows here like this. It was almost too easy a trade. And the market doesn't often do easy. Sometimes it does, but usually doesn't. So to do this now, have another run up, blow back into the trading range, you're going to have a lot of shorts get blown out there because they were sucked in here. They shorted the back test, or they should have, and maybe that's maybe that's it, guys. Maybe that's all it is. That's why these are dotted arrows. But I'm leaning this way. Again, just based on gut feel, intuition. I looked at there's quite a few market leading stocks. I'll get to those in a second at key support today. Again, we're near term oversold. That was a pretty hefty drop yesterday. And there's still a lot of economic events on the calendar this week, and you still have that giddiness that I predicted back on August 5th when the market bottomed. I said you're going to hear this narrative. You're going to hear the narrative, and it's going to be spun as bullish at the Fed's now that locked in the rate cut. On August 5th, I said the rate cut is now, in my opinion, 100% locked in. You're going to start hearing that. That's why they're going to buy the market and give us that double-digit rally we just had. And now you're going to, some of that, I think some of that is going to be returned to the markets this week. Anyways, guys, this is micro stuff. If you're a long-term swing or trend trader, just disregard what I'm saying. Sometimes when I expect volatility and a grind in the market, I'll sit here and sling the NQs or ES back and forth to get a 0.5% sometimes only. Usually the trades are about 1%, sometimes 2%. 0.75%. So that's all. I just gain these little micro squiggles and, set stops appropriate. And a lot of times I'll go 3 for 3, 4 for 4, or 4 for 5. And that's what I'm looking at now. So this is kind of the sweet spot right here. If I can get a thrust up here today and or into tomorrow, and then with a maximum bounce to right here. And so there it is, guys. That is if this happens, if we get another thrust back into the range, this is a sweet spot for a scale in, scale out of longs, close them out or scale out, and then short from here up to, but not above that level. Oops, I didn't mean to do that. There it is. That's 56.10. This one's about 55.90. I just put a horizontal line there. Let's look at the updated charts now because I'm going off the ones that I posted for you earlier. There it is. It doesn't get much better than that. Boom. So ES hit. That's the line right there, 55.66, bottom of the recent trading range. Breakdown, back test, and as I said before we got there, that'd be an objective short entry. I showed it to you on SPY, and hence the reason why we reversed a little shy on so far on SPY. But and it still is. Look, I'll maintain what I said. You can put a stop, a tight stop if you nail that entry today for the shorts. Or you can give a more liberal stop. Like I said, the midpoint of the range, you can see it right here. And there's where I added the line in. I had hand drawn that line in right there about 55.90. So again, this is where if you are a swing trader, trend trader, you might consider your stops at this point now. And especially if you're trading ES or factored into your NQ trades, we really shouldn't get back in the upper half, upper quadrant there, or upper hemisphere, I should say, of the trading range. NQ. This is the NASDAQ futures 15-minute chart. I believe this was shared with you even on Friday, these levels here. This was that recent resistance we were getting rejected on. I kept highlighting boom, 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 boom. Big drop yesterday, right back to resistance where they sold it. But again, this would be if we could thrust it up, because again, the market doesn't do easy, and this is too easy. It's almost too obvious. It smells of a trap to me, bear trap. So anyways, that's kind of how I'm gaming it. Reversed it here right before the video, and won't get married to it. Like I said, I don't expect fireworks. Sometimes I'll pull my stops, give it a little room towards the end of the day. I kind of, trading, if I'm not at my desk, I always have to have a stop when I leave. If I'm at my desk, sometimes I'll feel the market out. And then what I'm about to do is look at all the market leaders. But that's a potential bounce target up there if they want to blow out some stops in the shorts. So there's SPY. That's the 5-minute chart. I think I gave it to you. Yes, I did on the 15-minute chart today. It's the same boxed area right there. That's our range. Those are the levels. And QQQ, like I said, just not as clear. That was a support we were at today, this morning. There's a bounce up. You can see that's where I had given you arrows this morning. Where is it? This morning right here, my first arrow break was at that level right there, and that's the target we hit. So that was my minimum target. And it coincided with when we hit that target. Again, that's for... what is that there? Let me go back to my chart here. 465.20. And as I always say, you want to sell a little shy of the actual resistance level you're targeting. Again, it's just not worth it. Why is it worth it if you need to hold out for the last penny, which is a small fraction of 1%, and risk a reversal? So with all the trades that I give you, my price targets, I used to way back in the day sit there and take the time to kind of do a manual adjustment and then label it T1 equals, and I'll do the adjustment. But it's simple. Like I said, it's all, just sell a little bit shy of the target. And then, again, watch the S&P 500. Why did QQQ reverse shy of and that's a gap, by the way. That's there's a big old gap. That's this top reaction point there. And it reversed shy because at that very same moment it peaked here. ES happened to hit the bottom of the trading range, and then SPY reversed a little shy of its level. So if we go back up, that was where I had the first arrow break. And remember, arrow breaks, the other reason I list arrow breaks on the trade ideas is those are levels where I think a reaction is likely. And so I also, sometimes I will, but I also used to draw the little reaction. It just gets I don't have room to fit it all the time. So each arrow break is a resistance level where a reaction is likely. And that's exactly what we had today. And so there's a reaction. And the $1,000,000 question, is that going to be it? And as I told you, I don't think so. Could be. I'm open to that. But this is what I think we'll probably get. And that'll help blow out some more short sellers. And then maximum target, as I had on those arrows this morning, up to that downtrend line. And I'm very much open to that. And let me show you another reason why. So I just mentioned we have some market leaders at support. This is Apple right here. Apple, you have, this is a daily chart. Remember, Apple put in a divergent high and an island cluster top, followed by a breakdown of the bearish rising wedge pattern right there, this uptrend line. So you had 3 different high probability sell signals there. And then, of course, the big drop. And so today we've come down to, this is a gap right here. And there's the top of the gap, and that's exactly, if I look in real close, I'll even adjust the line down to the exact bottom right there, the candle right there before the gap, and that's what we hit today. So Apple's at support. It's not super solid support, but it's not just the gap. You also had reaction highs here. You danced on it here. It's more of a support zone, and so that's that. Microsoft, I had a support level here forever and a day. I've had that here for over a month now. You can see created on August 6th, and we hit that support level. It's not super duper support. It's a minor support. Support level, you're probably likely to get a reflexive bounce. Like I pointed out yesterday, the QQQ, as well as a lot of these, are either have just crossed or about to cross over, a bearish PPO crossover. And so, again, I'm just trying to pick up nickels in front of a steamroller here. You can see Microsoft, like I said, and I covered these in detail yesterday. Beautiful breakdown and back test, well below the trend line, and just now it's riding this downtrend line off the highs, but it hit support today. Nvidia, covered my Nvidia short this morning because I still have the I told you before going into earnings that I had just put options. I'm holding those. Those are October, I believe. But the shares I covered. Why? Because we hit that primary uptrend line. It was the same uptrend line. It was the first target over here on the daily and weekly chart. And we hit it and had a huge reaction off it, and we hit it again. It's a level I do think will go, but it's not going to, they're going to buy it today because it's this first visit. The last time traders had an opportunity to buy that trend line like we did, we closed our shorts out there on August 5th, when we closed all shorts out and reverse long. And so those that did it, depending on how much you held, there was a 40% rally that followed. And so that was a kind of a no-brainer today too, and another reason to kind of expect a bounce. If Nvidia bounces, QQQ is going to bounce. Alphabet, yes, below the trend line the way I have it drawn here. I'm going to tighten this up. Why am I doing that? Because I can see I'm not connecting here to any of these candles. I'm going to pull it up. That connects me to the bottom of those candles right there, and we're a little bit above that one. What I'm doing, and I say I do this all the time, the charts are dynamic, and so is my analysis, and I'll tweak my trend lines. Now it fits these candles better. It comes in right at that low and right where we're at now. And why did I do that? Well, we also are at the 200-day moving averages. And as I often say, you always know that I have two on my chart. I have both the 200-day exponential and the 200-day simple moving average. And I do that because some traders use one, some use the other. Therefore, I use them both. Sometimes they buy the 200 simple, sometimes they buy the exponential. So I want to see them both get taken out. However, as you've heard me say 1,000 times over, support is support unless broken. So the last time Alphabet hit the 200-day moving average, we had a tag of it, the exponential there, and a bounce of 7.5% followed. Again, it's a level I think goes. But I think they buy it again. They've been buying it. Like I said, both humans and machines are conditioned to buy the 200. It's not just humans. Algos will buy, computerized trading programs will buy pullbacks to the 200-day. People certainly buy pullbacks to the 200-day. They bought it there. They bought it there. I mean, come on, guys. This is simple stuff. Now, if it goes, look, it's not so simple. Sometimes they'll trick you. It's all collective. Collectively, what are all the big Mag 7 stocks doing? If you see 4 and then 5 out of the Mag 7 down, especially on daily closes below the 200s, and the indexes QQQ and or SPY, it's safe to say the 200s have now been taken out. Get short, strap in, and hold on unless those 200s are regained. But as of now, we keep testing the 200s. You can't get overly bearish or too aggressively short, especially when you're having a pullback to the 200-day moving averages. So I'm just kind of showing you today, why we just may, and this may carry through to tomorrow. This is Amazon. Amazon took out the 200s, briefly recovered, back tested again, and it's still, you can see here, kissing that 200-day simple today. Also, like a lot of these big market leaders in these downtrend lines, guys, keep in mind, these downtrend lines I don't have one on Apple. I have one on Microsoft. Keep an eye on these because a pop above these trend lines would be bullish unless it fails. And that could be the catalyst for a decent counter trend bounce. As of now, it's resistance. As I like to say, resistance is resistance until it's broken. So you can short bounces back to that level. But you better respect a pop, especially if both Microsoft, Nvidia. Nvidia's downtrend line is way above. We're comfortably above it now, but obviously bullish if it breaks out over it. Alphabet, beautiful, well-defined. Why is that beautiful and well-defined? 1, 2, 3, 4, 5, 6, 7 candles there. So again, watch it. This one's pinched between a rock and a hard place, meaning support and resistance. Support being the primary uptrend line in the 200-day moving averages, which we're right on right now. That puts Alphabet in a very precarious technical posture. It puts, the bulls on the defensive, right? Because we're on those key support levels. Just like when you're, threatening a breakout to new highs, then the bears are on the defensive. That's a bullish technical posture. Right now we don't have that. So the risk right now, I mean, we could step in and buy it here, and you can look at it glass half full or empty. Right now you have to look at it for what it is. We're at support. We're at the 200-day moving averages and in close enough proximity to that primary uptrend line to not be able to say it's been taken out yet. I think it will be. Could be taken out today, tomorrow. I think within the next week or two. I think the turn's already in, as I repeatedly stated my trading plan all along. Just to reiterate for those that are new, from a longer-term swing perspective, these are my swing/trend targets on QQQ. And other than gaming two little counter trend, 2 counter trend bounces in here, my plan was short down there, covered reverse. That was the bigger gaming of the bounce there. We gamed that one for a couple days, got back in short, grabbed the rest of it. And now this is where I said I'd let us go with stops above there. And this, pretty much as far as I was willing to let this rally go, as far as I expected that it might go. And so scaled back in short. And now I'm talking, what I'm talking about, guys, because I'm probably confusing the heck out of the new subscribers. I'm talking about my long-term accounts, swing accounts, trend accounts, IRAs, things like that. Where you can short in IRAs, you can, obviously you can use inverse ETFs, but certain brokers, I don't know how many, Interactive Brokers has margin IRAs. So guess what? I go long and short futures all day long, no tax consequences, and I do it all the time. You can short futures in Interactive Brokers in their IRA accounts, NQ, whatever you want. So that is, how you can, game. And that's my plan, as I've told you, is to swing it down here. We'll see if and when we get to T3. Again, if and when. We could just do this, and then all this is for naught. I won't, on anytime soon, I'm not going to change, modify, or tweak these targets. As of now, that's my plan. If anything different happens, I'll let you know. I mean, there's a myriad of possibilities. We could grind sideways here for months. Anything's possible, but I doubt it. Based on the VIX spiking, as I talked about when it started spiking here, I said that was the initial shot across the bow, in my opinion, that there would be more to come. The VIX started perking up again yesterday, most certainly. And, I think things will start to snowball here. By Friday, we should know. I think after Friday's jobs report, we should have a good idea where this market's going. So, okay, guys, that's it. Long-term kind of swing trend trading plan. That's a trend trade, calling for a trend change from a bullish trend to a bearish trend. And then everything else I was talking about earlier in the video is just what I call micro analysis, aka active trading. It's not for everybody, so if that's not your wheelhouse, don't just ignore things that I post on 5-minute charts and 15-minute charts. Alrighty, let's give you an update on wheat, because T1 is now hit 517. Remember, you don't want to hold out for the last. If that's your plan to sell T1, this thing, like I said, I think I like it, but I'll tell you what, I'm going to like it a lot more if and when T1's taken out. It is resistance, but you can see we've got this nice potential basing pattern. This was support, support, support. Then it broke support, back tested, backtesting now. If it does this, guess what? Then all this was a big, what we call bear trap. Short sellers pile in, and then they start to get squeezed out here. And again, the charts are constructive, which makes it seem like, appears to me it will happen. And again, I've laid out the case. I'll probably add longer term targets, additional targets there. But I did want to update it because T1 has now officially been hit. So that's it. ZW wheat futures is a little shy of the comparable level there. Again, these are futures, can be priced a little different. T3 is your next target, and you can see it's really nice. Again, with support, we broke that support, backtested, rejected every time. It's a big level. So if and when that pops, definitely be adding targets, but that would be your next target there. It's T4 628. And remember, guys, it's just like when I'm bullish on gold and silver. To be bullish on gold and silver is almost always to be bullish on the miners, GDX. SIL, the silver miners ETF, they're going to follow. And the same thing with wheat. As far as corn and soybeans go, remember, these are the grains, the three big grains are corn, wheat, and soybeans. There used to be one ETF that held them all, JJG, but they've retired that one. So now you have to trade them separately via CORN is the ETN. You can see the divergent low that I've been highlighting, bigger and bigger, bigger, and then the wedge breakout. It's been rocking, coming up here, downtrend line, potential targets. That's the 60-minute chart. There's the daily chart. These are longer term targets, big divergent low here. So just like wheat, I see the potential for a bottoming play in corn. Corn, like all commodities, peaked back when COVID hit, along with the stock market, had what appeared by all metrics that I track on the long-term charts, a new bull market underway. This was the bear market from started back in 2012 in corn, bottomed here, and by every metric and technical analysis, including the downtrend line, the primary downtrend line off the highs being taken out, and then all the previous reaction highs being taken out. That is the definition of a downtrend. Downtrend is lower lows and lower highs, and an uptrend is higher lows and higher highs. So this was, and remember, we took out these previous reaction highs as well. And so this just appears like the initial leg up in a new bull market, corrective wave, with most likely more upside to come. Either way, whether that's going to prove to be the case, that's long-term stuff. I can tell you definitively that this is a very good support level right here. What is that, about 1750? Give or take. You can see it there again. Major reaction high, some consolidation, not just a breakout and a limp around, an explosive rally once we broke above there. That helps to validate that as a technically significant level, and we just back tested it for the first time since that breakout back in 2021, and we did it with positive divergence and oversold conditions, so right for a bounce. In fact, I've been bullish on these guys for a while. We hit, we had a divergent low there, and we hit first target, but it pulled back. That was resistance. Never cleared through T1. We need to go up there and then break T1, and then it opens the door to these other targets. And then same thing, soybeans. Sometimes soybeans will lag a little or lead a little, and this is what they're buying right now. They're buying these ag commodities. We've got a rate cut, 100% certainty that the Fed is now pivoted. They even said they pivoted. They haven't done it in action, but in rhetoric, they've acknowledged they pivoted. And so now it's time to kind of return. I don't think we're going to see screaming runaway inflation. I think when the stock market craters over the next year or so, there'll be a deflationary effect there, most likely. However, institutions and individuals, but more so the institutions, smart money, who are more diversified, have to put their money somewhere, and they're going to put it in things with better risk-reward profiles than NVIDIA and Apple and Amazon. And I know commodities are boring. Nobody, last time you went to a cocktail party and talked to somebody about soybeans was probably never. But I'd like to trade these for both diversification, asset allocation, as well as just pure, when they look good, give me anything with a ticker. I don't care what it is. Bitcoin, you name it. Bitcoin, I'll get to that soon. I watch it all the time. I just there are times, if you followed me for a while, I'm posting trade ideas day in, day out. Sometimes threading the needle. I have a pretty darn good track record on trading crypto, but I just haven't been feeling it lately, so I've been standing aside that trade. And when the time is right, I will start posting some setups on it. And nat gas is doing its thing, still holding off those recent lows / divergent lows. Already, these are the targets. Remember, T1 was hit here, and it was just hit again. It was resistance then. It was resistance once broken becomes support. We hit it, we bounced it, and then we broke it, but now it's resistance again, about $14. Need to break it. And remember, we've already hit T3 when we had that divergent high. So ideally, we come up here and then pop that, and that's when natural gas should run, if and when that happens. Okay, and if it doesn't, don't get married to it. Call it the widowmaker. Very few commodities can put money in your hands so fast or take it away from you so fast as natural gas. Like I like to say, she's a trendy little sucker. When she wants to run, she's often full throttle up, and when she decides to go down, she's full throttle down, and she can make oversold look like nothing. She'll just get oversold, and you just keep getting more oversold, more oversold, more oversold. So never fall in love with a position in natural gas. But trades pretty well to the technicals. So and the key is too, guys, just keep your position size down. That's it. If you want to know what, I can tell you, this is as, if not more volatile than the triple leveraged QQQ ETFs, meaning SQQQ and TQQQ, because I've traded natural gas for decades now. And I can tell you, I've seen many, many days where it's up 15, sometimes even 20% in a single day. QQQ rarely ever goes up or down 5%. That's an extreme. And so, those triple leverage, you're rarely going to get 15% days. So in other words, it's a kind of run of, the norm. This thing's up and down. The average is probably 3% a day. It's a typical move for it. And so, again, the way to successfully trade it, you don't put as much into this as you would into SPY or Apple or something like that, because it's going to, when it goes against you, you're going to freak out. It's going to exceed your stop allowance in dollar terms. Everything to me is relative. You might have 50% run in natural gas, but you're going to take your position size down small. And that'll allow you, if you're targeting a 50% run, you can give yourself a 12% stop loss and not get, take a dollar loss that's too large for you. All right, let me move on, and I think we'll wrap it up. Let me see if there's anything else. Just this. Watch that yen. I mentioned it yesterday. You've got the primary uptrend line. That's very important. We're not far from it now. On the very, very short term, on the 60-minute chart, I have an uptrend line, which we've cracked below. We're a hair below, but we're also above this downtrend line. So again, today, I think it's going to be grindy. I kind of give you my near-term outlook, which I'm favoring. Let me check the economic calendar for you, and then we'll wrap. Okay, remember, Thursday after the close, Broadcom. That's going to be a big one for the tech sector, for the NASDAQ 100, for AI, and all that stuff. Tomorrow, big day, big day. ADP employment report, jobless claims, productivity, PMI, ISM service index at 10. So a flurry of them come before the market opens, and then you have a couple reports coming after the market. If you're trading natural gas, be aware. Every Thursday they report their inventory reports, just like you get crude on, I believe it's Wednesdays was crude. Either way, natural gas is every Thursday, and then you have the employment situation on Friday. So that's all I can tell you guys. There's a flurry of potential and almost certainly market-moving reports coming out in the next day or two, next 2 days, as well as one of the biggest, the second largest chip maker in the U.S. reporting earnings tomorrow after the bell. So strap in, hold on, and you can have your bias. It's where you think things are going. One of my pet peeves are those people that think they're traders and they say, "Oh, just trade the market that's in front of you." Trade. You got to have a bias. You got to know which way, because when a stock is approaching support or resistance, you got to know: am I going to buy that pullback to support, or am I going to sit tight, not buy it, and wait for it to break in order to short it? That's where I try to formulate my bias of where things are going. But I can say this week, don't get married to that bias, and especially don't get married to positions. If the news brings the market down, in other words, if jobless claims spikes up, that's really a big one there. But I've already showed you the turn has already come in the labor market. So we had an aberration on the last one, a little up blip, but a downtick. I'm sorry. There's your consensus right there. And if this comes in hot, it probably will be spun negatively. I say that because for months, for about the last year, good news in the stock market was good news, but bad news was even better news because the market was so addicted to the easy money that they said, oh, any bad news on the economy would be good news because it means the Fed would cut rates. And I always kept saying, be careful what you wish for. You can see that point when finally the job market turns, which it clearly has. I don't have that chart queued up, but I've showed it to you. It's clearly turned the corner at a point where we've never in history seen it go up that much and not have a recession follow, and also not be the bottom in employment. Here, I'll just show it to you. For those new, go to macrotrends.net. They've got some great charts. Go to economy and go to national employment rate right here, or you can look at jobless claims, but I like to look at the national employment rate. And this is that hook that I'm talking about, the turn. And again, you have these little micro squiggles, when unemployment is falling and the job market's strong, the unemployment rate's going down. Those are just the normal, month to month, week to week aberrations there, whatever on the reporting periods. But then you can see we've clearly turned the corner. And look at the acceleration. You got to step it up here a little bit. You can see the acceleration. So this is the near-term trend. And this is what I'm talking about. We get these little blips here. So, and you can look at this chart on your own. Remember that, and that's been the bull's single largest citation as to why we're not going to see recession, because employment's so low, so strong, the job market's so strong. But again, it's just like the stock market always peaks on rosy news, and stocks always peak on blowout earnings, the big tech stocks. I've seen that time and time again. All economic expansions end on record low unemployment. And again, you can say, well, this can keep going down, but this is, again, it would be very atypical to see such a clear reversal, which is accelerating when you look closely here. I think you can see that in the video. I'll zoom in as much as I can. You can see the recent acceleration there. And like I said, it's I struggle to find a point where we've seen such an acceleration, such a clear turn, like I'm showing you here, and you see the gray lines. I think you see the gray lines. Hopefully you do in the video. These gray lines are the recessions. They mark and show all recessions. Even this one, it was there. It was COVID, and it was a quick one because the Fed and the federal government, all governments around the world, and all central banks around the world threw out the nuclear option and made it very short. But you can see all the recessions there, and you can see all the troughs in the job market, and you can see the turn. We're going back to the 60s there. Modern history is pretty clear. This is pretty much the range right here where, at least in recent decades, where unemployment's bottom. So that's that, guys. And we'll see. Maybe this time it'll be different. Famous last words, right? But there's just a lot of technical evidence in the charts, as well as economic indicators like I just showed you that say that's it. The writing's on the wall. Yield curve, I think I heard uninverted this morning briefly, or was it yesterday, for the first time? And remember, it's not the inversion of the yield curve that has correctly predicted all the last 7 recessions without fail. It has, but the timing factor is when it uninverts, in which it just did. I heard, check that later to verify that. All right, let's wrap it up here. I told you it'd be a short video, and here I am rambling on, but slow day, so I figured you guys can watch it, and you have the kind of where I think things might go today and how to trade it into tomorrow as well. The day is getting, so we're halfway through, and there's that 15-minute chart of QQQ, and there's that SPY. Let me just go to where I started with SPY. Again, kind of showing you my trading plan for the day. Game the bounce, close it out, reverse it, reverse back long again, from short to long, and see if we can get one last thrust up here, but not give it a lot of room there. I'm happy to go flat with what we have on the calendar tomorrow. In fact, before I end the video, let me say this. I'm not going to go long into it. If anything, I'm going to go back short. And I'm talking about my active trading account as well. The other account's still staying short. Nothing's changed there. Yeah, I think the risk is skewed to the downside. But it's also, it's a bit of a gamble when it's like going long or short a stock into earnings. So just keep that in mind. If you're somewhat risk averse, you can always lighten up on your positions, hedge up, and do whatever you want there. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.